Welcome back to the deep dive. You know the drill here. You bring the sources, all those articles, notes, charts you've been looking at, and we dive in really deep. Our job to pull out the absolute key takeaways, the nuggets of knowledge, maybe those surprising connections, and just make sense of it all for you. Today, wow, we're diving into the big one, the crypto market. Where does it stand right now? You've given us a lot to chew on, focusing hard on Bitcoin, its price, where it might go next, but also looking at the other big players, Ethereum, Solana, XRP, Chainlink, Polygon. So our mission in this deep dive is to weave all that together, the technical charts, the market cycle theories, what the blockchain itself is telling us, the liquidity picture. Try and give you a clear view of what's actually happening.
Yeah, and it's a great mix of sources you provided. We've got really detailed technical analysis looking at different time frames, which is crucial. We also have commentary on market cycles. Are the old rules still applying? Plus, that core on-chain data, what's happening fundamentally. And then, yeah, liquidity, order books.
It's always.
Here's the money sitting. Trying to synthesize that is the goal.
Absolutely. Now, before we really get stuck into the charts and data, there's something important we need to address up front. It comes directly from one of the sources you showed. It's basically a disclaimer, and it really frames how we should think about this kind of market analysis. It's worth hearing right at the start.
That's right. It's pretty standard, but good to reiterate. One source included this specific point, and I think it's vital context. It says, and this was originally in Polish, so I'm giving you the direct meaning here. This material is for informational purposes only. It does not constitute investment or financial advice, or a recommendation to buy or sell anything. It goes on. The content presented is the author's subjective commentary. The author isn't responsible for any investment decisions made based on this. Every investment decision should be preceded by your own analysis and, if needed, consultation with a licensed financial advisor. And it ends with, this is just our commentary on the market situation.
Right. So straight from the source. This is analysis, it's commentary, it's their take on the data. It's not advice telling you, buy this, sell that. And that really underscores a key point, doesn't it? Information is one thing, but your decisions are always your own, based on your own research, maybe professional advice if you need it. We're here to unpack the commentary that you brought us.
Precisely. It's about understanding the perspectives in your sources, what they're seeing, why they think that, not getting marching orders.
Okay, perfect. With that important groundwork laid, let's dive in. Bitcoin, it's usually the main driver, right? So let's start there. Your sources seem to agree it's at a really interesting point right now, a technical crossroads, maybe?
That's a good way to put it. What's really striking is the, let's call it, tension between signals on the longer-term charts versus the shorter ones. It's quite stark. If you zoom out to the weekly chart, for instance, one indicator they mentioned, the super trend, is still green. Okay, which usually means the bigger uptrend is technically still in play. But on that same weekly chart, the MAPD, which measures momentum, it's clearly slowing down. The bullish momentum is weakening. It hasn't crossed bearish yet, but that upward curve, it's flattening out a lot. So just the steam might be running out on this scale.
Okay, so the trend indicator says still up, but the momentum says slowing down fast on the weekly. That sounds like a contradiction almost.
It is, yeah. And adding fuel to that cautionary fire on the weekly, there's a major bearish divergence. One source flags this as already confirmed. This is classic stuff. Price makes a new higher high, but the RSI, the relative strength index, makes a lower high. Means the strength behind the price move is less than before. And that source points out, historically on the weekly, this pattern has often preceded a pretty significant cool-off or correction. They mentioned mid-2023, the end of 2021, periods where this showed up before drops. So big picture weekly, warning signs are definitely flashing.
Okay, wow. So weekly view, slowing MAD, confirmed bearish divergence, definitely suggesting, be careful, maybe a bigger pullback is on the cards based on this analysis. But you said stepping down in time frame changes things.
It does, yeah. If we drop down to the 3-day chart, we see a similar kind of warning sign starting to appear, though it's not fully baked yet.
Yeah.
The MACD lines in the 3-day are getting really close to a bearish crossover. Hasn't happened yet. But the fact they're converging like that, it echoes the weekly signal. Declining bullish momentum in the medium term, too. It's another piece pointing towards a potential slowdown.
So more evidence of weakening momentum, potential for a pullback stacking up on these medium to longer term charts. But the price has bounced recently, hasn't it? And it's holding above a key level your sources mentioned. This is where that tension comes in.
Exactly. This is the other side of the coin, the counterbalance to those bearish signals. Multiple sources zero in on one critical support area. Source 1 puts it between roughly $101,000 and $102,000. Source 3 slightly lower, maybe $100,000 to $101,000 being vital. And the price did react there. It bounced off that zone. And source 1 draws a really clear line. They basically say, look, we only turn bearish on the trend if Bitcoin closes daily candles below that 101K, 102K area. As long as we hold above it, then technically the larger bullish trend could still be okay. The recent drop could just be a shorter-term correction, a breather within that bigger move up. So that price zone is massively important.
Okay, and here's where it gets really granular and maybe a bit confusing. One source points out that on the 12-hour chart, much shorter term, the RSI actually broke above a previous high. They specifically say this invalidates a bearish divergence that was there on that 12-hour time frame. So while the weekly 3-day are showing caution, the 12-hour just gave a little bullish flick.
That's a fantastic nuance to pick up on, and it perfectly illustrates the crossroads idea. So yes, while the bigger picture shows weakening momentum, potential trouble, that 12-hour RSI break, invalidating its own little bearish divergence, it suggests that right now, in the very immediate term, the downward pressure has eased enough for momentum to tick back up slightly. It takes away one specific bearish signal that was active on that chart. So that supports the idea that this current bounce from the 101K area has some short-term legs, even if the longer-term picture still looks a bit shaky below the recent highs. You've got signals pulling different ways depending on your zoom level.
Right, navigating that is tricky. Okay, let's focus now on those specific price levels and patterns. If that crucial $100K, 101K support doesn't hold, what happens then? Where do the analyses see price going?
Okay, yeah, that support is the pivot. If we lose it and we see daily closes confirm below 100K or 101K, multiple sources agree that likely triggers a bigger downward move. And they point to specific chart patterns. A big one mentioned is a potential head and shoulders pattern forming on Bitcoin's chart. If the neckline of that pattern, which sits right around that critical 101K support, breaks down, the standard technical target for that pattern points down towards roughly $95,800. That's based on the height of the pattern projected downwards.
Head and shoulders targeting mid-90s. Any other patterns pointing that way?
Yes, another source looked at a rising channel that Bitcoin broke down from recently. They calculate the target based on the height of that channel, projecting down from the breakdown point. Their target, around $97,500. So you've got two different patterns analyzed by different sources, kind of converging on a target area between, let's say, $95,800 and $97,500. If that key 100K, 101K support gives way, that mid to high $90K zone becomes a very credible area to watch. The overlap adds weight to it.
Okay, so losing 100K, 101K isn't just a minor slip, it's potentially activating these patterns pointing significantly lower, maybe 95K, 97K. Makes that level incredibly key. What about the upside? Where's the resistance?
Right, to kill off these bearish ideas, we need to break resistance. Source 4 flags resistance around $106,000. That's important because it was the previous all-time high closing price, and it's acted as a flip zone before resistance became support, now maybe resistance again. Source 5 gets even more specific, pointing to $106,200 as the top of a recent 10-day trading range on the daily chart, basically where sellers stepped in consistently over the last couple of weeks.
And getting above those levels, say 106K, 107K, what does that signal?
Breaking decisively above $107,000 is seen by one source as a pretty significant bullish signal, at least short-term. Why? Because that level is apparently the neckline of a smaller, shorter-term head and shoulders pattern. Breaking 107K would invalidate that bearish structure and could target higher liquidity levels, which we should talk about. Source 4 also mentions resistance near the absolute peak, the all-time high, maybe 108K, 109K. So yeah, layers of resistance overhead too.
Okay, this brings up something interesting.
Yeah.
One source brings Elliott wave theory into it. They mention seeing a 5-wave structure on the way down from the highs. What are the implications of that specific count? Yes, Elliott wave. If you follow that methodology, this is a really critical point from source 3. They're interpreting the drop from the recent peak, they put it around 112K, as potentially a completed 5-wave impulsive move down. Now, an Elliott wave, after a 5-wave impulse in one direction, you typically expect a corrective bounce in the opposite direction, a 3-wave move usually, before the original trend either resumes or reverses completely. So the crucial implication here, as source 3 sees it, is this. If that was a 5-wave move down, then this current bounce we're seeing, it must eventually make a new high above the starting point of that move above 112K to fully negate the bearish potential. It doesn't matter if the bounce starts from 101K or even lower like 97K if support breaks first, it has to exceed 112K. So just getting back up isn't enough. According to this theory, making a new all-time high is actually technically required to say, okay, the bearish threat from that drop is over.
Exactly. From that specific Elliott wave perspective, yes. Source 3 argues that if this bounce fails to get above 112K and instead rolls over and forms what looks like a 3-wave corrective structure,
Well, that massively increases the odds of another five-wave move down. It would mean the correction isn't finished and could go much lower than just the head and shoulders target. So whether Bitcoin pushes past 112K after this bounce is, from this viewpoint, absolutely critical for the bigger trend. Failure is a big bearish flag.
Fascinating how these different lenses give different triggers. Okay, let's connect the charts to the plumbing, the mechanics. Buy orders, sell orders, liquidity. The stuff that actually moves the price. Your sources looked at this too, right? Order flow.
Definitely. This is where you look at things like liquidation maps, order book data. One source calls it fire charts. And it's really valuable because price often gets drawn towards areas where lots of orders are clustered. Liquidity magnets, basically. And one thing multiple sources agree on is a big concentration of liquidation levels sitting around $107,000. This is where a lot of leveraged short positions are clustered. So if the price moves up there, it starts triggering those shorts, forcing them to buy back Bitcoin to close their positions. That adds buying pressure, accelerates the move up. A classic short squeeze scenario. Source 1 seems quite convinced price is likely heading to 107K just to trigger that liquidity.
So hitting 107K isn't just about technical resistance. It's potentially about triggering those vulnerable shorts, causing a cascade.
That's a key part of the interpretation, yes. That liquidity pulls the price towards it. And supporting that potential short-term upward move, several sources note that funding rates are negative right now. That just means shorts are paying longs a fee. It makes shorting less attractive, makes going long slightly more attractive. It adds a little bit of upward pressure, especially when you're near a big liquidation cluster like 107K. Now, looking at the actual order book, the bids and asks, sources 4 and 5 show where the big buy walls, bids, and sell walls asks are. There's significant buy liquidity below the current price. Source 4 sees a cluster around 104K. Source 5 highlights a big chunk right around that critical 100K, 101K support level we keep mentioning. These act like a buffer, a defense line. Sellers have to chew through those orders to push price down.
Okay, strong bids below. What about sell walls above? Is there heavy resistance stacked up?
Yes, definitely. There are noticeable sell walls, ask liquidity, sitting above us. Source 4 shows big clusters starting around $110,000, going up through 111K, 112K. Source 5 actually uses a great term. They call it a sandwich of liquidity, meaning you've got these big buy orders down low around 100K, 101K providing support, and big sell orders up high, 110K, 112K providing resistance. The price is kind of stuck in the middle. It suggests it's hard for price to make a really massive, easy breakout or breakdown right now because of these walls on either side.
Good.
Could lead to more choppy sideways action within this range.
That sandwich idea makes sense, but one source mentioned a rug pull risk related to that buy liquidity. What exactly does that mean here? Sounds ominous.
Yeah, it's an important warning about how big players can operate. So we see those large buy orders on the book below looking like strong support, right? But source 4 warns sometimes that's just an illusion. Big players can place huge buy orders to make it look like there's strong demand. Then, if the price gets close, they can suddenly cancel those orders. Poof, the support vanishes. And the price can then drop really fast because there's nothing underneath. It's like pulling the rug out from under traders who bought thinking that support was real. It's a tactic whales can use to maybe trigger a cascade down so they can buy cheaper.
Okay, so visible support isn't always guaranteed support. Good to keep in mind. What about who's actually doing the buying and selling? Any insights from the volume data?
Yeah, source 4 looked at cumulative volume delta, or CVD, broken down by wallet size. CVD basically tracks if buyers or sellers are being more aggressive. And their data showed that the larger wallets, the whales, represented by brown and purple lines on their chart, they've actually been net buyers recently during this chop. Meanwhile, the retail wallets, the orange line, haven't shown much buying interest. So it suggests maybe accumulation is happening by the bigger, perhaps more sophisticated players, even at these levels.
Interesting. So the smart money, or at least the bigger money, seems to be buying the dips or accumulating here, even if the price isn't exactly rocketing.
That's what that specific CVD data points towards, yes. However, Source 5 adds a really important caveat here. They mentioned that some traditional tools used to track whale movements, like something called the Big Whales Explorer, might be less reliable right now. Why? Because of the Bitcoin ETFs. There are now huge transfers happening between institutions, custodians, ETF issuers, just logistical movements related to creating and redeeming ETF shares. These look like massive whale transfers on the blockchain, but they aren't necessarily directional bets by individual whales. They can skew those traditional whale metrics, making it harder to say definitively whales are bullish or whales are bearish, just based on those movements alone.
Oh, okay. That's a crucial distinction in this new ETF world. You have to be careful interpreting those big blockchain moves now.
Right, let's zoom out even further. The bigger picture. Your sources talk a lot about how the whole market might be changing, especially because of these ETFs.
Yeah, this is probably the biggest macro theme running through the material. Multiple sources really stress this point. The U.S. Bitcoin ETFs launched in 2024. They aren't just another news item. They could be fundamentally changing the game, altering the market cycles we've seen before.
How might they change things compared to, say, the old 4-year halving cycle models that everyone talks about?
Well, Source 2 argues pretty strongly that just relying on those old halving cycle patterns might be misleading now. The ETFs have opened the floodgates to massive institutional capital. We're talking traditional asset managers, pension funds, advisors putting client money in. This type of capital operates differently, different time horizons, different regulations, different strategies compared to the retail crowd or even the crypto-native funds of the past. This huge influx could reshape the cycles. Maybe we get less crazy parabolic blow-off tops, maybe longer periods of accumulation or distribution. Maybe the timing relative to the halving itself changes. It's all potentially on the table.
And there's some evidence the timing might already be shifting.
Source 2 thinks so. They point out that market tops historically often occurred around a similar point in time after the halving. But this time, the significant correction or consolidation we saw happened earlier relative to the April 2024 halving than in some past cycles. That could be an early sign things are different now.
Okay, shifting gears slightly, but still big picture, one source drew this really interesting parallel between Bitcoin and gold, suggesting Bitcoin is starting to act more like a safe haven. What's the thinking there?
Yeah, Source 2 builds this case on a few things. First, obviously Bitcoin's market cap is growing, though still way smaller than gold's. They cited something like $2.2 trillion versus $22 trillion. But the key is behavior during stress. They point to times of currency crisis or economic uncertainty. Think Turkey, Greece, Venezuela, where you saw capital flowing into Bitcoin, similar to how gold behaves. And they also noted periods where Bitcoin held its ground, or even went up, while traditional markets like the S&P 500 were falling, suggesting some decoupling, some safe haven characteristics emerging.
So it's not just a story people tell, there's actual market behavior, especially now that big money can easily access it via ETFs, that supports this idea of Bitcoin evolving into a safe haven.
That's the argument Source 2 is making, yeah.
Yeah.
They even mentioned how gold ETFs were introduced before periods of increased global financial stress, drawing a potential parallel there. Maybe these accessible vehicles signal a shift in how large players view these assets.
Any other big macro correlations mentioned?
Yes, Source 2 also talked about the relationship between Bitcoin's price and the global M2 money supply, basically, the amount of money sloshing around in major economies. They suggested Bitcoin tends to follow M2, but with a lag, maybe 80 to 100 days or so. And based on recent M2 expansion, if that correlation holds, they projected it could point towards Bitcoin hitting $140,000, maybe $150,000 in the not-too-distant future. Essentially, more global liquidity fuels Bitcoin's rise.
Okay, from money supply to other cycles, sources mention things like political cycles and market manipulation again.
Yeah, Source 2 brought up historical patterns around U.S. elections, how markets often move up once the uncertainty of the election is resolved, and how that upward move is often helped along by algorithms constantly buying the small dips. But the bigger point they hammered home was that market structures, including manipulation tactics, tend to repeat. Doesn't matter the price, the year, the news. These things happen again and again. They specifically talked about those sudden, sharp price drops, arguing they're often designed deliberately to shake out retail traders, scare them into selling in panic.
Right, we touched on this with the rug pull idea. So these flash crashes aren't always organic. They can be calculated moves by big players to scoop up cheap coins from frightened sellers.
That's exactly the case Source 2 makes. They describe how big money can engineer these quick drops to hit stop losses, trigger emotional selling from retail, allowing them to accumulate lower before letting the price recover. Understanding this manipulation as a recurring pattern, regardless of the news story attached, is key, according to them.
Okay, thinking about the overall market now, not just Bitcoin, the total crypto market cap chart was also discussed in your sources. What's that telling us? Is it looking healthy or weak?
Looking at the total market cap gives us that broader view, including all the altcoins. And interestingly, both Source 3 and 4 identified a potential head and shoulders pattern forming on the total market cap chart too. Similar look to Bitcoin's chart. Source 3 stressed that losing key support on this chart, particularly around the $3.18 trillion level, would be a pretty significant bearish signal for the entire crypto market.
And does that pattern have a target too? If $3.18 trillion breaks.
Yes, if that head and shoulders on the total cap confirms by breaking its neckline around $3.18 trillion, the measured target points down towards approximately $2.92 trillion. Source 4 added that breaking below the 200-day moving average on this chart, which is nearby, would be further confirmation of broad market weakness.
Okay, but how does Bitcoin's dominance play into this? Can the total cap fall without Bitcoin breaking down badly?
That's a really important point from Source 3. Bitcoin's dominance is high, around 64.6%, they said. So if Bitcoin does have a major correction, the total market cap will likely fall even harder percentage-wise because altcoins usually bleed more. However, Source 3 also raises the possibility that the total market cap could fall towards its target, down to $2.92 trillion, without Bitcoin necessarily breaking its own key support around 100K, 101K. If Bitcoin's dominance increases significantly, meaning altcoins are selling off much faster than Bitcoin is. So you'd see the total value drop sharply, mainly due to altcoin weakness, while Bitcoin itself holds relatively firm. It's a possible scenario.
Got it. So total market cap has its own warning signs, but Bitcoin's relative strength matters hugely. Okay, let's switch gears now to those specific altcoins you brought sources on. It's not all about Bitcoin for everyone.
Right. And while alts often follow Bitcoin's lead, they each have their own specific technical setups. Your sources gave us snapshots for a few key ones. Let's start with Ethereum, ETH. Source 1 sees it bouncing within a sideways range right now. Key support for them is around $2,400, with resistance up between $2,700 and $2,800. Like Bitcoin, it's getting a short-term relief bounce inside this range. Source 1 also spotted a potential bullish flag pattern forming. If ETH can break and close above $2,800, that flag pattern could target a move up towards $3,200 or $3,300. That would be a significant breakout.
Any other takes on ETH?
Yeah, Source 4 saw a slightly different pattern, an ascending triangle. Resistance for them is around the 200-day moving average, support around $2,330. But both sources noted that some indicators for ETH, like MACD and Stoch RSI, are starting to look more bullish, suggesting upward momentum might be building. Still, Source 1 thinks more sideways chop is likely the immediate short term before any big break. And order book data shows resistance starting right around $2,700 anyway.
Okay. How about Solana SOL? Always
Yeah.
a popular one.
Solana's also in that short-term bounce camp, according to Source 1. It bounced nicely off major support between $143 and $146. It's likely just riding Bitcoin's coattails for now. But Source 1 did highlight an active bullish divergence on Solana's 8-hour chart, like we discussed earlier, that usually suggests upward momentum could continue for a bit. So they expect this relief bounce to last maybe a few more days for SOL. Key resistance levels to watch, initially around $157, $158, then a bigger zone up between $180 and $185.
All right. In XRP, what's the story there from your sources?
XRP, according to Source 1, bounced right off its 50% Fibonacci retracement level, just above $2, around $2.07. That area, $2 to $2.10, is also strong historical support. They see a potential double bottom pattern forming. If that confirms with a break upwards, the target could be around $2.44. Resistance is seen near $2.35 first, then that $2.44 target. And crucially, just like Solana, XRP also has an active bullish divergence on its 8-hour chart. So again, Source 1 expects this bullish relief to continue for XRP for the next few days based on that signal.
Okay. Seems like a theme here with these 8-hour divergences. What about Chainlink, LNCAP?
Very similar story for Chainlink based on Source 1. It's getting that short-term bullish bounce off key support at $12.80. Now, they do caution that the daily chart structure for Link still looks technically bearish overall, but for now, it should benefit from the general market relief bounce. Resistance areas for Link are flagged around $14.10 to $14.20, and then a tougher zone between $14.90 and $15.50. So short-term relief expected, but the bigger trend still needs proving.
Got it. And finally, Polygon, Matic. You mentioned one source was particularly less enthusiastic about this one.
Yeah, that's right. The analysis for Matic from Source 4 was notably more bearish, quite different from the others. They describe it as being stuck in a clear, long-term downtrend. Just consistent lower lows, lower highs. And importantly, they said even looking at longer time frames like the weekly, they just don't see any clear bullish reversal patterns forming. Nothing suggesting a major turnaround is imminent. So because of that persistent downtrend and lack of signals, their suggestion was mainly for range trading Matic. Maybe buying near the bottom of its recent range, say 15 cents, selling near the top, maybe 30 cents, not really looking for a big breakout. Order book shows some support near 20 cents, resistance near 25, but the clincher. Their CVD analysis showed very little buying interest from the big players, the whales, in Matic right now. That lack of large player accumulation really reinforces their cautious stance.
Okay, so a clear difference there for Matic. Seems like the general theme is Short-term bounces, likely for most alts, following Bitcoin, but keep an eye on those key levels, and Matic is maybe the exception stuck in its downtrend. Now, let's move beyond the charts and order books. Your sources also looked at on-chain data, what's actually happening on the blockchain and sentiment. Are there more positive signals hiding there?
Yes, absolutely. This is where the narrative gets a bit more encouraging, kind of balancing out some of the technical caution we talked about. Several on-chain indicators point to more fundamental underlying strength, despite the price jump. One big one is stablecoins. Source 4 highlighted that the total supply of stablecoins is hitting new all-time highs. That's generally seen as bullish. Why? Because those stablecoins are basically sidelined cash within the crypto ecosystem. They represent potential buying power, money that's usually intended to eventually buy other crypto assets like Bitcoin or alts.
Right, so more stablecoins means more dry powder, ready to jump in if sentiment shifts or prices look attractive.
Exactly. It's potential fuel for future rallies. And complementing that, another really positive on-chain signal from Source 4 is the amount of Bitcoin sitting on exchanges. That number has been dropping significantly. It's hitting multi-year lows. Fundamentally, that's bullish because it means less Bitcoin is readily available to be sold quickly on the open market.
Ah, so less supply immediately available for sale, while the potential buying power from stablecoins is increasing, sounds like a potential recipe for a supply squeeze down the line.
Source 4 definitely views that combination falling exchange supply, rising stablecoin supply as a strong positive fundamental divergence. It suggests that underneath the surface price action, maybe long-term holders are accumulating or moving coins to storage while new capital waits. They also noted that active addresses on the network, while kind of stable, haven't gone parabolic like they often do near major market tops. This suggests maybe we haven't hit that peak retail frenzy or widespread participation yet, meaning the ultimate top might still be further out.
Okay, interesting fundamental picture there. What about sentiment? How are people feeling? Your sources had slightly different readings on the fear and greed index, didn't they? One said 45 fear, another 62 greed.
Yeah, the little discrepancy is interesting. It could just be down to when exactly they recorded the reading sentiment shifts fast, or maybe slightly different ways they calculate the index. But the key takeaway from both readings, whether it's 45, which is pretty neutral, leaning slightly fearful, or 62, which is moderate greed, is that neither is at an extreme. We're not seeing the extreme fear you get at bottoms, nor the crazy off-the-charts greed you see at tops. So sentiment seems kind of balanced, not overly stretched either way, which can actually be healthy, allows room for movement without an immediate sentiment-driven reversal.
And did the sources say anything about managing sentiment?
Yes, Source 3 made a good point about how sentiment really impacts retail traders. Emotions like FOMO driving buying at the top, panic causing selling at the bottom. That's where retail often gets hurt. They contrasted that with professionals who try to manage emotion by, for instance, thinking about trading in terms of accumulating units of Bitcoin rather than just the fluctuating dollar value. Trying to detach emotionally. It's a mental trick to stay disciplined.
That's a great practical tip. Focus on the units, not just the dollar signs. Okay, wow. We have covered a ton of ground here in this deep dive, pulling from all those different sources you provided. Technicals, cycles, on-chain, sentiment, Bitcoin, alts.
Yeah, it really paints a complex picture, doesn't it? Which is pretty typical when the market is consolidating or at a potential turning point. You've got clear signals for short-term caution from the technicals, especially if Bitcoin loses that crucial the 101K support. Momentum is flagging on bigger time frames.
Right, that caution is definitely there. But then it's balanced by those pretty strong underlying on-chain metrics, like coins leaving exchanges, stable coins piling up. That suggests fundamental health.
Exactly. And then layered over everything is this huge question mark about the ETFs. How much are they really changing the game? Are past cycles still relevant? It feels like we're in this tug of war around key levels with different indicators telling slightly different stories.
So pulling it all together, what does this mean for you listening?
Well, it means really understanding the importance of those key levels, especially that 100K, 101K deal zone for Bitcoin. That seems to be the big trigger. It means maybe paying attention to those positive on-chain trends as a sign of underlying health, even if the price is volatile day to day. And definitely recognizing that the market structure itself might be evolving because of these huge institutional flows. Old playbooks might need updating. And crucially, remembering that point about manipulation. Those sharp, scary drops. They might not always be organic panic. As Source 2 suggested, sometimes they're tactics to shake you out. So patience, focusing on the bigger picture and key levels, maybe not reacting to every little wiggle. That seems like a common thread here.
Definitely. Okay, let's wrap up with our provocative thought for you to mull over. Building on this whole theme of ETFs, institutions, and Bitcoin may be becoming a safe haven. Here it is. If the same powerful financial forces and capital that drive traditional markets are increasingly moving into crypto via ETFs, and if Bitcoin is starting to behave more like gold within that existing system, what does that do to the original idea of crypto? The idea of it being truly free, decentralized, outside the traditional system. How does deeper integration change its fundamental nature in the long run?
Something to think about for sure as you digest all this. Thanks for diving deep at us today.
We really hope unpacking all the material you brought us is giving you some valuable perspective. Until the next deep dive.